Hey everyone, Matt from Stock Trades here. Welcome back to another video. Today, we are going to look at a couple of stocks that you might want to avoid. But before we get into that, I just want to let viewers know that we will be flashing 2 discount codes Stock Trades Premium up on the screen. We don't know when, it'll happen throughout the video, and the first 2 to use that code will get Stock Trades Premium at a 50% discount. Don't wait. Once a code is used, it's expired. So we are only giving away 2 of those 50% discounts this video. So with that in mind, let's get to a couple of stocks that you'll want to avoid right after this. First, let's take a look at some of my past picks. It's been a few months since I did one of these videos, and I wanted to double check to see how the last 3 picks turned out. So let's take a look. In early June, I singled out Canadian Natural Resources, Total Energy Services, and Ceridian, cday.to, as stocks that investors may want to avoid over the short term. At the time, oil and gas stocks were up significantly from their lows, and I felt as though these jumps in prices were unwarranted. Furthermore, Ceridian was firmly in overbought territory based on its 14-day RSI, and I thought it was also due for a short-term pullback. As you can see from this chart, all 3 have since declined by double digits. Ceridian is down by approximately 10%, Canadian Natural is down by approximately 17%, and Total has actually cratered and is now down more than 30%. As you can see, when stocks jump and rise significantly over a short period of time, investors might want to think twice before taking a position in those stocks. Which brings me to the first company that investors might want to avoid, and that is KP Tissue, symbol KPT.to. KP Tissue is Canada's leading tissue company. And if you'll remember, at the beginning of the pandemic, there was a mad rush to secure and stock up on tissue paper. KP Tissue benefited, and it continues to benefit as the pandemic drags on. The company operates in 3 segments: the consumer market segment, the away from home market, and the private label market. The company has some of the most well-known brands in the country, from Cashmere to Scotties to Purex, Sponge Towels, White Swan, and White Cloud. These are among the most well-known names in the tissue segment. As Canada's #1 tissue paper, it has a 35.5% market share in the bathroom tissue segment. It has a 30.9% market share in the facial tissue segment, and finally it has a 21.5% share in the paper towel segment, all of which are almost double its nearest competitor, which is Irving. As you can see, this is a leadership position that they've been in for quite some time. Although it has slightly been decreasing in the facial tissue and paper towel segment, the company still holds a dominant market share and has had a dominant market share for the past 5 years or so. Since the company is a leader in the market, naturally it will do quite well if the demand for tissue paper is on the rise, as it has been throughout this pandemic. So why is this a company that I would suggest investors avoid at this point in time? Quite simply, valuation and momentum. If you take a look at KP Tissue's current price chart, you'll see that the company recently underwent a pretty significant spike. And this occurred over the last week or so. It jumped from approximately $12 per share, which it has been hovering at for the better part of the past month, up to above $13 per share. Naturally, such a big spike is a reason for concern. Not necessarily because it's a bad company, but because the company's share price might be becoming overbought. And as you can see by this chart, the 14-day RSI chart, KP Tissue is clearly in overbought territory. As a reminder, a 14-day RSI above 70 is an indication that the company's share price is in overbought territory and may be due for a short-term pullback. In this case, KP Tissue's 14-day RSI has now hit 80, one of the highest it's been this year. It did so again in early August, and if you remember the previous chart, in early August, the company's stock price pretty much traded flat for the majority of the month. Now that the share price has spiked again, investors will want to exercise caution here. This is not to say that KP Tissue is a bad company. It's actually an excellent company and one that is well positioned to take advantage of perhaps a second wave and a second shutdown. If that happens, a company like KP Tissue is sure to benefit. In fact, I would guesstimate that The recent spike in share price is a direct correlation to the fact that cases are on the rise. We are nearing a second wave and potentially a second shutdown. Given this, investors are already starting to bid up the company's share price. That being said, I'm not a buyer here. I would wait for a short-term pullback. It is definitely in overbought territory, and at this point, I'd wait and see what happens. Which brings me to my second stock to avoid, Maganese X. This is a company that has generated a ton of buzz lately, mainly in large part due to Tesla's battery day. A little background here. Tesla is one of the few EV vehicle makers which does not use lithium manganese batteries, powered batteries. It actually uses a cobalt base. There are many reasons for which that manganese is preferred over cobalt, price being one of them. And currently, there is no pure play manganese mine in North America. So a company like Maganese X and its Battery Hill project, which is expected to be one of the first manganese mines in North America, would naturally generate a ton of attention. This is especially due to the fact that Tesla's battery day is expected to come with big announcements. Now, what that looks like, we do not yet know. However, the prevailing theory is that Tesla may, in fact, switch to a lithium manganese base for their batteries. If that's the case, a company like Maganese X is obviously becoming of interest and may be of interest to a company like Tesla. However, this is all buy on the rumor. I cannot stress this enough. Let's take a look at its chart. As you can see, the stock price has done absolutely nothing until Tesla's battery day was announced. Since then, the company's share price has absolutely skyrocketed. It has gone from approximately 10 cents here and is now trading at 80 cents per share. Now, it's dipped slightly from the 96 cents per share, but at 80 cents per share, it's not justified. This is all based on complete rumor. Now, let's take a look at its 14-day RSI chart. As you can see, the company's chart has been in overbought territory for quite some time. If you'll notice, that pretty big dip from 96 cents per share occurred when it was almost at an RSI of 100. That is absolutely insane. The amount of speculative investors who are investing in this stock is through the roof. And this is why investors should avoid it. Don't follow the crowd. The easy money has already been made. Have you ever been cautioned, or have you ever heard of the saying, buy on rumor, sell on news? This is a classic example of something that is setting up to be a sell on news type case. Tesla's battery day is coming up on Tuesday, September 22nd. It's going to be a big day for the markets, and investors will be looking at it quite closely. What if nothing comes of manganese? To this point, there has been no clear indication that Tesla is going to alter the chemistry of their batteries. So if it doesn't, a company like Maganese X, whose current share price has been bid up all as a result of Tesla's battery day, if it doesn't, it might drop significantly to pre-battery day levels, if you will. I'm not saying that Maganese X is a bad company, and I will fully acknowledge two bull scenarios. The first, rising demand for manganese. If you look at this chart, the demand for manganese in batteries is expected to grow 23% year over year through 2027. That is impressive growth. Furthermore, the industry is currently relying on China primarily for the supply of manganese, and there is a big need for North American production. I fully acknowledge that. Second, I acknowledge that there is a family tie between Maganese X and Tesla. Tesla has partnered with Jeff Dawn, who is a battery researcher out of Nova Scotia. Jeff's brother, Roger, is on the board of directors of Maganese X. So there is a clear link there between Tesla and Maganese X. However, this is still a company that has shot up by 750% over the past month. This is not something that I would go chasing. If you were one of the lucky ones who got into Maganese X well before the current run-up in share price, good on you. I would strongly suggest that you book your profits. We don't know what's going to happen come battery day on Tuesday. What we do know is that Maganese X is an exploration and development company that has a few properties that will potentially lead to a mine producing manganese. That's all we know for a fact. Everything else is pure speculation. That's not investing. That's akin to gambling. That's for the investors who are looking to strike it rich, not for us. So with that in mind, we strongly suggest investors don't jump on the momentum train. If something comes of Battery Day, we'll revisit then, but for now, it's pure speculation. And with that, we're at the end of our video. I recognize that my thoughts and perspectives on Maganese X may be controversial. I know that stocks like Tesla have a cult following, and investors are very high on Maganese X and this potential relationship with Tesla. However, we must also look at things from a fundamental perspective. I'm a fundamental investor and not a momentum investor. This is purely based on speculation and momentum. In terms of KP Tissue, I like the company. I just think I would wait for a short-term pullback given that it is firmly in overbought territory. I hope you liked the video, and if you did, please click the like button and subscribe to our channel for more great Canadian content. Until next time.